US stocks have risen for a fifth straight week, reaching yet more record highs. Gold is also around record levels, and the US dollar has come under pressure as Fed rate cut expectations rise and as the US government shuts down. But what should we be watching next week? To talk us through the outlook, I'm joined by Global Head of Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So the market appears to be looking past the shutdown for now, but a lack of fresh data points surely adds a level of uncertainty. What general market conditions should we expect to deal with next week, and what markets are you watching?
The funny thing about looking through the US government shutdown is I don't think they're actually ignoring it. They're just taking advantage while they can. And this is the same kind of mentality that we've seen with tariffs, which we're still in the midst of. The uncertainty is still quite clearly there, and we just don't seem to be paying attention. We have the uncertainty of monetary policy, obviously, with the Fed under heavy pressure from the White House and from a lot of the Fed's detractors, and a lot of speculation about the path forward there. And again, the markets aren't paying much heed. And now we have a lack of clarity around the health and bearings of the economy because of the government shutdown also carries with it the burden of a lack of insight into the data, which was already under scrutiny and heavily questioned because of things like the NFPs revisions and the annual revision not long ago. And now we have a delay in the release because of the shutdown. This is all significant fundamental underlying uncertainty. And yet, the markets continue to push forward with risk appetite, and the popular saying always is the markets remain irrational longer than you can remain solvent, which is very true. It's a statement on a rationality or irrationality of individuals or crowds, and in the crowd, the market can always look for opportunity and just stick with complacency. And a lot of people, if you try to rationalize the irrational, it can lead to going down the wrong path and not trading or investing in the market that you're actually put in front of, rather the one that you think should be there, which is never a good opportunity or a good choice. But these markets are still fundamental bound eventually. Eventually, the deviation from these big underlying themes of uncertainty and risk and volatility will come to pass and will rebalance the markets. And given the themes that we are dealing with, I think the markets to keep tabs on to see when we do have a rebalance or whether we are still uh, kind of deviating from that norm. The dollar, obviously, at the center of a lot of this monetary policy, tariffs, anti US sentiment, especially with the US government and the ballooning debt. You have gold, which is a good counterbalance to fiat and especially the dollar, and keeping it really US centric. I'm also going to be watching US Treasury yields, specifically the 3 month, 2 year, and 10 year. 3 month is good for liquidity, 2 year is good for interest rate forecasting, and 10 year is more indicative of the economy. So, those are like the big high level markets that I'd watch for to see how conditions are aligning to the themes.
Yes, and talking about themes, what are the most potent themes that could drive bulls or the bears next week?
It seems very one dimensional right now. I don't want to negate the possibility that we'll come back to the uncertainties of growth. Obviously, as data comes out and we could take a hard left turn, we did see consumer sentiment this past week, especially in the United States, is continuing to erode. So there is obviously something there with growth and the uncertainty of growth. You also have regional Fed GDP forecasts are actually quite robust. So it's not a one direction, it's negative. But there is a lot of interest there. It's just not catching a lot of market traction. You have trade conditions. Obviously, those tariffs, we're not going to have them really weighed on, and the president's ability to execute reciprocal tariffs is not going to be seen by the Supreme Court for a while now. So it's in the back burner. Monetary policy clearly is in the back burner, although we'll see when we can actually get the tangible data for them to rule off their dual mandate. Right now it really does seem just purely focused on this government shutdown, which is interesting because we are continuing, as we said, higher despite the government shutdown and the implications that usually carries. The government shutdown is quite complicated in terms of how far it can reach and how much impact it can have. Historically, we've seen U.S. government shutdowns not really register that big of an economic impact. Now, I say not that big, but the last one was the record long shutdown, and it carried over from the December into January in the president's first term. And it did account for tens of billions of dollars of lost GDP. But it did not necessarily have very long lasting implications, and it didn't have any credit issues. So we didn't have any credit rating agencies give another rate cut to the US sovereign rating. But this one's a little bit different in that there is also the possibility of losing jobs permanently rather than furloughs. So a lot of uncertainty. Obviously, we are going to be on tenterhooks to see when we actually get the data release that we need, the non-farm payrolls. We also have the CPI coming up soon, and we want to see if that's going to hit the wires when it's supposed to hit the wires, so that we can get better bearings as investors and traders and market participants on the U.S. economy. So the theme really is um, the government shutdown and how expansive and influential that can be.
And then what about event risk? Given that potentially we're facing a US data desert next week, what could be the top event risks that we could spur themes off and kick off a new focus?
There's not a lot of event risk on the docket this week, and I don't know if that's going to be good or bad. Usually, the markets like to have little milestones to look ahead to, knowing that a non-farm payroll is coming out on a Friday, or we're coming into a Wednesday FOMC rate decision. But when you're left without these big anticipatory events, it can also allow markets to start developing trends and themes outside of the context of that individual piece of event risk. But that being said, Monday, fairly empty. I mean, if you can watch the Japanese FX reserves, the Mexican consumer confidence figure, those do tap into some trade considerations, but nothing really high level. Tuesday, we actually have some noteworthy stuff. I would be watching, you have the Canadian trade balance, Canadian manufacturing activity index, the IV. But I will be watching more the US run, because we actually have US trade balance. We have US economic sentiment from the RCM. The New York Fed is going to be releasing its consumer inflation expectations, which, in the absence of the BLS data or the questions of the BLS data, is going to be much more interesting. We have the LMI, which is a supply chain or shipping index, and we also have the New York Fed's actual supply chain index. So these are usually second tier indicators, but they're more indicative in a world where we're questioning the principal frontline data points. Wednesday, fairly empty. RB&Z rate decision, the FOMC minutes. I don't think you're going to get to anything too dramatic there for market movement. Thursday, again, empty. Chinese FX reserves. Jerome Powell will be speaking, but he has been speaking for a while and nothing has really changed. He just uh, plays the consummate punching bag for his detractors, and tries to carry on with the "I will be data dependent" script. But Friday, Canadian jobs, and then two U.S. data points that are going to be important. I would watch the U.S. budget figure for September, obviously, in the questions that we have around debt in the United States and the shutdown. But the University of Michigan Consumer Confidence Report, definitely going to be an important one, because in the absence of the quality or veracity of the data that we have on these more mainstream series, consumer sentiment is going to be a leader, because it's not going to be questionable, because they are going to say this is our sentiment. So it might have more traction in weighing some of the policy decisions, but also in how the markets interpret the economy, broadly speaking.
Excellent. Well, thank you very much for your insights once again, John.
Thank you.
For more videos like this, please do like and subscribe.